What I'm looking to do here now is just basically any sort of retrace into this zone now becomes major support. So again, it was resistance pulled back, hits, consolidates, breaks out. Now it pulls back. I want to be a buyer off this 34.75 zone for a move to the upside. And I actually still think silver probably, I don't know about this year, but I think it within this year or next, we at least tag that 48 to 50. The idea here is that gold should continue up. You will probably see some resistance at the all-time high just because that's your natural last major high. But my guess is gold is going to continue to go higher here over the.
Silver prices declined to approximately $36.20 per ounce during Monday's Asian trading session, pressured by a recovering US dollar that weighs heavily on USD-denominated commodities. While the greenback strength has created near-term headwinds for silver, analysts believe the downside remains limited due to escalating geopolitical tensions in the Middle East, which typically support safe haven demand for precious metals. Despite current market pressures, veteran trader and chief market strategist Gareth Soloway, known for his technical analysis expertise, maintains a constructive outlook on silver's prospects. Soloway identifies the $34.75 level as critical support and views it as an optimal buying opportunity for investors. His technical analysis indicates that silver should rebound from this support zone, with potential to reach $48 to $50 per ounce within the next 12 months, supported by strong technical fundamentals. This optimistic forecast aligns with projections from other market professionals. Sunil Kashyap, director at FinMet, similarly expects silver to target the $48 to $50 range, which would represent price levels not seen for more than a decade. These bullish predictions reflect growing confidence in silver's underlying strength, despite short-term market volatility driven by currency fluctuations. The bullish case for silver extends beyond technical analysis to fundamental supply-demand dynamics. According to Shanghai Metals Market, tight inventories in New York and London are fueling price pressure, making the market highly sensitive to demand spikes. Gold's strong performance adds further support to precious metals, with Soloway noting it has turned resistance into support and is set to break all-time highs, driven by the same macro forces boosting silver. The gold market's remarkable performance over recent years underscores the strength of precious metals as an asset class. Gold prices have surged more than 90% over the past 5 years, with no indication of cooling momentum. Historical analysis reveals that gold prices demonstrate a persistent long-term upward trend, making it an attractive consideration for investors seeking portfolio diversification and wealth preservation strategies. Before we begin, don't forget to subscribe, click the bell icon, and share this video with anyone who'd benefit. Your support helps us keep bringing you valuable insights.
What we had was this longer term uptrend from the start of the year, right? And what we can clearly see is that uptrend is still intact, right? If we connect these lows, right, low to low to low and to low, that's your longer term uptrend. So even when we were down here and we made the high at 3,500, and then in the short term we were making high, lower high, lower high, that was still holding the longer term uptrend. So the idea is you still remain with a bullish bias because the longer uptrend is still holding. And then what you can see here is amazing, right? So you had the high here, you connected to this high, price broke out, it then came back, which now becomes support, right? It was resistance here, here, and here. But once it breaks, this now becomes support. It held support and is now pushing up. So again, the idea here is that gold should continue up. You will probably see some resistance at the all-time high just because that's your natural last major high. But my guess is gold is going to continue to go higher here over the. This is a very interesting chart, and I went long on a breakout on gold, on silver here, but I actually did take profits just because of the extension move. But the key is I'm still a bull on silver. I just have to wait for a pullback. And we're starting to get that over the last few days. What I'm looking to do is what we see here is you basically have this zone right here, right? So very clearly notice how this high and this high here kind of make a zone. Then you had it hit here. And then right in here, if we zoom in, notice how price went up, consolidated, and then broke out. And so as a technical trader, what I'm looking to do here now is just basically any sort of retrace into this zone now becomes major support. So again, it was resistance pulled back, hits, consolidates, breaks out. Now it pulls back. I want to be a buyer off this 34.75 zone for a move to the upside. And I actually still think silver probably, I don't know about this year, but I think it within this year or next, we at least tag that $48 to $50 level on silver. You look at silver going back to 2024, basically a year ago, until this recent breakout, silver's just chopped sideways. And so it hasn't benefited from the move up in gold, which has been basically up and to the right. It recently broke out, and I attribute that not so much to industrial demand, right? I think industrial demand is stagnant, if not dropping. But I think what's going on here is that you have this divergence with the ratio between silver and gold, the silver gold ratio. And it's gotten so stretched at this point that at some point, either gold has to pull back to where closer to silver, or silver has to play catch up a little bit. And I think that's what we're seeing on silver. So the idea is that if gold goes higher, silver should benefit to some extent and also go higher. And keep in mind, I mean, even if silver goes to 48 to $50, and if we look at the chart here, you can see that all that does is gets us back to the high from 1980 and the high from 2011, right? So even though gold is making new all-time highs, silver is still lagging on a basis of new all-time highs. But I do think the catch-up trade is something to kind of monitor here. When you look at the bigger time frames, that's really where we start to say, and this is where we start to speculate. And again, for everyone watching, it's important to understand is that you have a higher probability of predicting the future when you look a week out, a month out, maybe a few months out. When you say, okay, well, where could gold go over the next couple of years? I mean, we're all guessing a little bit more. What I use is I like to say, okay, what's my best case scenario for gold? And what I do in this situation is I look at the last bull market runs, right? So you had gold down here in 1976. It ran up about 850%. Here you had a low in 2001 over the course of essentially 10 years. It went up 600%. And then if we look here and we kind of take this low and we say, okay, well, right now we're only up about 200%. So, I mean, if we just kind of average those two gains, 800 and 600%, even if we just did, let's even go a little bit less. Let's say 400. So 400. You're still talking about an incredible move up here on the price of gold that could continue. So, I mean, we could be looking at $6,000 an ounce during this bull run. And again, if you look at what's going on in the fiat currency system, you look at how the new bill in the government, it doesn't really look like it's going to cut that much spending and most likely expand the debt. Those are the ways where you start to say, okay, I could justify gold getting to $6,000 an ounce potentially because of these other factors.
Gold prices surged to $3,445 per ounce during Monday's Asian session, reaching a one-month high and attracting significant buyer interest. This rally reflects growing investor confidence in gold as a primary safe haven asset amid escalating global economic uncertainties. Veteran trader Gareth Soloway offers a compelling perspective on gold's potential, noting that historical bull markets have delivered gains of 850%, while the current cycle shows only 200% appreciation. Soloway projects gold could reach $6,000 per ounce, driven by mounting government debt and political reluctance to implement spending cuts. His forecast reflects the structural fiscal challenges that make gold increasingly attractive as protection against currency debasement and monetary risks. Market analysts echo this optimism, projecting gold could hit $6,000 by the end of Trump's term in 2029, an 80% increase from current levels. This timeline aligns with expectations that supporting factors, including inflation concerns, geopolitical tensions, and unsustainable debt levels, will persist and intensify. Let's get back to the interview.
There was last night, and what's really interesting about this is what we've seen, at least on the long bond here, is that last night yields were down. We were down to about 4.32%, but we've actually moved up today on the 10-year. And so it's weird how you did see kind of that safety trade going on, but now we've seen it somewhat reverse, at least in the long bond. And again, that continues to make me very nervous about what foreign investors think about the long-term U.S. debt, right? I mean, 3 and 6 month, 2 year maybe is fine, but what about 10 or 30 years out? And you start to see this type of thing, like generally you would expect the 10-year yield to be down today, and it's not, in spite of what we're seeing in the news. I would also think gold would continue to rally higher in the near term. And weirdly enough, even if oil stalls out here because maybe things don't get worse there, I still think gold is a place where, as we see more and more unwillingness in the government to really do dramatic cuts, and the debt issues continue to mount, gold is just, it's your default go-to, and then Bitcoin kind of on the out. And I think that it's just, people get caught up in the emotion of how amazing the rally has been, and it has. This V-shaped recovery has been epic, but you also have to start looking at the data and thinking very logically, not getting caught up in the hype. And if you look at it, even if deals are struck, tariffs are still likely to be at minimum 10%. That's 10% higher than they were. And that's in the best case scenario. We're also seeing an economy that's very clearly slowing. I mean, the consumer is pulling back on spending. A lot of these signals just show the stress in the system that's been building up. And remember, I mean, the government is still trying to cut a lot of programs, the funding for a lot of programs, which will also influence spending quite a bit. So there's a lot of underlying factors that really point to, at least, even if not a full recession, a slowdown where the valuations on a lot of these stocks, it's going to be tricky to justify them going up significantly. So I think, again, for me, I'm more in the more bearish camp that I think we slow down quite a bit and go into a recession. But even if you're in the base case of, hey, listen, we just kind of continue to trudge along, how much higher can valuations on stocks and risk assets go? I think that would definitely unnerve a little bit more. And the idea is, if it's a more regional conflict and draws in more players, what you then have is likely the U.S. getting drawn in. And that would be something that would really kind of upset or rock the apple cart, being the market. So I think it, at this point, most of the other countries have come out, Saudi Arabia, et cetera, have come out and said, hey, we don't agree with them doing this to Iran, but they've really stayed back and said, hey, listen, this is between them, between this nuclear program. If that were to change, I do think that would be a much more systemic risk for the stock market, and you would see a much more sustainable down move. Okay. If we look at the daily chart here on the S&P 500, here's your April 7th low. We've rallied immensely off of those lows. So the markets are getting to a point where we're priced to perfection, meaning that the upside is probably limited, maybe back to the all-time highs or just above. But I think, again, until we see economic data that really gets people scared here in the U.S., investors are still willing to kind of say, hey, listen, all these other things that are happening around us, it's inconsequential as long as the U.S. economy stays strong. And just going over the recent data, the PPI, CPI numbers were okay. There was no jump in inflation. The jobs data from last Friday was okay. So all of these things are making investors say, hey, listen, we've bought the dip in the past. Markets and economy stuff are still okay. Let's do it again.
Gold and silver remain firmly supported by broader macroeconomic pressures, including rising debt levels, fiscal uncertainty, and shifting investor sentiment. As gold continues to lead with sustained momentum, silver stands to benefit from both its monetary and industrial appeal. With key resistance levels turning into support and long-term trends intact, both metals are positioned for further upside in the face of global instability and weakening confidence in traditional financial systems. What do you think? Will silver catch up to gold's momentum, or is gold set to extend its lead? Let us know in the comments below. If you enjoyed this video, be sure to like, subscribe, and share it. Thanks for watching.